Hey everyone, welcome to Cover Call ETF Investing. In this video, we're going to try to break down the news that HYLD has cut its dividend. Should you panic, sell tomorrow, or invest in this thing at all? In this video, I hope to do just an impromptu video regarding this news. And I wanted to start with an article that Hamilton ETFs just recently put out regarding the cut. Now we're going to go through the whole thing, but what I really wanted to do first before we get into these other charts and here is I wanted to show you all the big five holdings within HYLD. Let's keep in mind it's an ETF that invests in ETFs, and the ETFs that it holds hold the underlying stocks. Okay. But as of a note, pretty important, since the bear market of 2022, when HYLD was during its inception, the big five, JEPI, JEPQ, QYLD, XYLD, and RYLD all started to drop their distributions. And you can see that from JEPI to JEPQ. This is where HYLD, you can see here, this is where HYLD made some changes and started to invest in these. And you can see that they all went down. All five of these funds are variable funds, meaning that they pay out a different amount every single month based on the premiums generated inside each of the cover call ETFs. Again, XYLD, you'll see, was part of that initial launch back last year, has fallen ever since. And then with RYLD, it's fallen ever since. Okay, so today they finally cut the distribution from 14 cents a share to 12 cents a share after a year and 2 months of basically keeping it fairly consistent. They did raise it, I believe in May, May of 2022, they actually raised it by 25 cents, or not 25 cents, basically a quarter of a penny they raised it. I'm actually surprised that this hasn't happened sooner. Because Hamilton pays out a consistent, sustainable distribution where most of its underlying ETFs are more variable. The fact that it's been able to hold on this long has been actually quite surprising. And this article kind of gives you the reason as to how it has achieved this. So I wanted to, by all means, I've also linked the article down below in the description so you can read it for yourself. But instead of reading all this, let's just kind of get to the meat of this. This gives you kind of the insight into the fund as to how HYLD is able to maintain that steady dividend. But basically they have this yield rule of thumb. What that basically means is it's a weighted average of all the ETFs inside. So whatever the average yield is of all the ETFs, plus, or I should say multiply by the modest leverage of 1.25%, it wants to stay within a 1% narrow band, whether it's plus or minus. So you can see since inception in February of 2022, it pays out. This was the jump in the yield from all the other ETFs. We go to March 2022, the aggregate yield, average yield of all the funds within, it actually jumped up. Okay, and it was above the 1% threshold, which is Hamilton basically says that it tries to maintain a 1% range. So if it's above 1%, getting closer to 2%, they decided to raise the dividend. So you can see here, HYLD increases its distribution. And when it does that, it brings the average yield kind of back down to the medium level of 0%. I hope that makes sense. Basically, all that's trying to say is, when the underlying assets within each fund, they raise, HYLD makes a change to up the dividend or lower the dividend based on that aggregate yield. Okay, so as we can see here, we go throughout each month that it's paid out its dividend. It basically maintains this pretty close to 0%. As we get to September, it drops below 1%, right, the danger zone, and then kind of jumps back up. Then it kind of stays again just below 0%. And then as of March, it hits 2% negative. And what this now means is it had to compensate for the underlying assets. The yields have dropped. They also now have to drop their yield as well to maintain the fund. If it was to still pay out 14 cents a share, it's basically going to eat into your own capital, whatever you've invested into the fund. They're going to be paying you, they're basically going to be paying you back your principal, a portion of your principal along with the premium as well. So to avoid that, they have to get back into a safe range. They lower the dividend to basically 11.73%. And this now puts the fund in a plus 1% position, which maybe could possibly mean that they could basically raise the distribution again in the near future, basically. If it can maintain if it can maintain 1% and then maybe get closer to 2%. And hopefully the yields rise based on market fluctuations in the volatility, because for cover call ETFs, that's where the bread and butter is. Where there's volatility, that's where premiums are to be made. So with that being said, guys, my own opinions of this, when I initially saw it, I was a little choked to see that, but like I said, I'm not surprised. These other funds have been lowering their distributions for the last, call it 8 months, 10 months. And HYLD has been hanging in there with their steady Eddie dividend. Just keep in mind, HYLD, it must react to all of the underlying ETFs inside. It has to react, right? If all of those yields drop by, say, 50%, well, there's no way that HYLD could maintain what it has going on currently. There's just no way for it to. It must stay within this narrow band. And actually, before this article was made, I didn't even know how it's maintained. So it was great that Hamilton could put out this article, give us some education into how the fund actually operates and how they actually keep it relatively sustainable. If my explanation isn't quite as concise enough, then be sure to read this article a couple of times, because I think it does do the education justice and hopefully alleviates panic. And here's another thing, just so you guys know personally, I have two funds. I have HYLD inside my TFSA, and I have XYLD inside my RRSP. And this fund holds, where is it here? XYLD. So I've been pretty used to I want to say I got into XYLD back in August. So I've been pretty used to it dropping for the last little bit. Now, one thing people might not know with Global X funds, and Global X funds would be XYLD, RYLD, QYLD, is that as the share price increases, the distribution actually increases if volatility is if volatility is high enough, then it basically pays out 1%. It pays 1% based on the average price for that month. So I've been pretty used to that for that variable distribution. Okay. So am I worried about this? No, just again, it's I'm not surprised. I had thought about this before, but it kept paying out a steady 14 cents a share. Never really thought much of it, but the fact that it's able to give us a really detailed article like this, I think just shows, I've been following Hamilton for a while now, especially with their fund managers. They really, from everything that I can see so far, they really seem to care about the people who invest in their products. And goodness me, how important is that just to have that transparency? So I can't stress it enough, everybody. Please read this article linked in the description below. Hopefully this video calms some nerves. I'm not worried about this at all. I would say that it's just something that, so one thing with investing in covered call ETFs is that when volatility in the market is low, distributions will lower as well. But once volatility rises, so will the premiums as well. So it's never always going to be a rising action. It'll be kind of choppy and potentially on the way up, on the way down. Thank you all for tuning in. Hopefully you like this impromptu video, and be sure to like and subscribe, all the rest, and I will see you all in the next video.